Hello everyone, and welcome back to another tax talk. In this video, we're diving into a topic of Lifetime Capital Gains Exemption, also called as LCGE. It's like a once-in-a-lifetime, tax-free money for every individual in Canada. Normally, when you sell a property or shares and make a profit on it, that profit is called capital gain, and you must pay tax on it. I've made a separate video on capital gains. Feel free to check it out for more details. Let's go over an example to understand better. Let's say, I sold some shares and made a profit of $1 million. Ideally, I would have to pay tax on that profit, but instead, I can choose to use my Lifetime Capital Gains Exemption and not pay any tax on it. However, there's a limit for it. It's only tax-free for up to $1,016,836 of capital gains for the year 2025. So if I make more than this amount, I have to pay tax on additional capital gain. This limit changes each year, so make sure to check the amount of latest limit before making any decisions. You are eligible to get this exemption only when you sell specific kinds of properties, like qualified small business corporation shares, or qualified farm property, or qualified fishing property. Now, what makes the property as qualified? There are some criterias that should be met to make the properties qualified. For example, if you are selling shares of a corporation and want to use your Lifetime Capital Gains Exemption to bring the taxes down, then that corporation must fulfill certain criteria to be qualified, like, it must be a Canadian-controlled private corporation. That means, it should be a private corporation that is incorporated in Canada, and is a resident in Canada, and controlled by Canadian owners or shareholders. I've made a separate video on Canadian-controlled private corporation. Feel free to check it out for more details. Next criteria that the corporation must meet is the active business test at the time of sale. This means that, at the time you sell your shares, 90% or more of the assets of the corporation must be used in an active business in Canada. Let's go over an example to understand better. Let's say, I own a bakery. Now ideally my bakery should have ovens, delivery vans, and ingredients to run the business of a bakery. If it has all these items, and it makes income from them, then it's running an active business. But, let's say, instead, my bakery owns a condo in Miami as an investment, which has nothing to do with baking, then that means it's not running an active business, and therefore, does not meet the active business test. Another test the corporation must meet is holding period test for 24 months. Let's use the same example of bakery. I should own the shares of the bakery business for at least 24 months before I sell them. Let's say, I bought the bakery business from someone a month ago and sold the business within a next month, then it does not meet the test of holding period for at least 24 months. This test stops people from taking advantage of Lifetime Capital Gains Exemption, where they can quickly set up a company or buy shares and sell them, just so they can use their Lifetime Capital Gains Exemption and avoid paying tax. Next test is 50% asset use test during those 24 months. Throughout the 24 months before the sale, the corporation must have used more than 50% of its assets in an active business in Canada. Let's use the same example. In my bakery business, I should use more than half of my assets in active business. Like, use my truck and oven to actually bake and deliver the baked goods, and not for any other purpose like Uber or taxi. Since all these tests revolve around active business income, there is high risk of not being able to meet these tests if the business has too much cash, or investments, or rental properties, which are not related to active business. Hence, many tax planners use a purification strategies, like moving out excess cash or investments before a sale, so that the company passes the active business test. Now remember, each individual has their own Lifetime Capital Gain Exemption limit. That means, each shareholder of a business can use their own Lifetime Capital Gain Exemption to bring the taxes down. Therefore, families sometimes use an estate freeze or share structures to combine their exemption limits. Let's go over an example to understand better. Let's say me and my spouse, we both own shares in the bakery business. We sell the business and earn profit of $2 million. Now, we can each claim the Lifetime Capital Gains Exemption of $1 million each. So, We don't have to pay any taxes on that $2 million gain, as both mine and my spouse's lifetime capital gain exemption was used to bring it down to zero. Hope you have a better understanding of what lifetime capital gain exemption is and how it works. That's all for this video. If you have any questions, comments, or would like me to explain any other tax topic in detail, please feel free to drop a comment below. If you found this video helpful, please give it a like, hit that subscribe button, and share it with your friends who could really use some help. Good luck. Bye for now.